Rising interest rates make the cost of financing property more expensive, something that real estate investment trusts understand all too well. The relationship between interest rates and REITs might scare off some investors. In fact, REITs are 47% correlated with interest rates, with only regulated utilities having a higher correlation. The Federal Reserve has increased the federal funds rate multiple times since December 2015. The forecast for the total 2018 calls for 3 or 4 rate hikes, with potential rate hikes in 2019. Over the past decade, there were 3 periods that demonstrated sharp negative relationships between REITs and interest rates. But over the long haul, REIT cash flows can improve if the rate hikes reflect a booming economy. As for recent performance, REITs have lagged the market with a 2.7% total return over the last 12 months compared to the S&P 500's 14.8% return. But past performance is no indication of future returns, and with REITs, it's worth looking at the bigger picture. But the choice of sector matters. Some REIT sectors fare better than others when interest rates rise. When rates increase, equity REITs tend to rise to the occasion while other REITs lag. From 1972 to 2013, mortgage REITs had a negative return during rising rate environments, losing about 4.1% annually. Over the same period, equity REITs returned 9.8% in the rising rate environments. Composite REITs returned 5.1% when rates rose. The obvious choice is to steer away from mortgage REITs as rates rise. But how do you choose which equity REIT to pursue? Here, too, the answer lies with the sector the REIT is in. Some argue interest rate increases are a good thing for office and residential REITs because of the correlation with the economic growth and increased demand. But investors need to make sure returns are on track with the forecasts. While REITs can be affected by changes to the federal funds rate, it's the 10-year U.S. Treasury rate that matters the most. When you do want to avoid REITs, and when they almost always underperform, is when the 10-year Treasury has hard, fast, and unexpected upward movements. Treasury yields are influenced by economic growth and inflation. When the economy is strong and inflation is expected to rise, the price of longer-term Treasury bonds can fall, triggering higher rates. REITs took a hit in February after the Fed raised short-term rates and the 10-year Treasury reached 2.94%. The 10-year Treasury yield hit 3.12% in mid-May and continues to hover near the 3% mark. Rising rates should be viewed in the context of your broader financial plan and investment horizon. But investors should remember that historically, a huge chunk of the market's total return has come from dividends, not stock price appreciation. According to Morningstar data, 82% of the S&P 500's total returns since 1960 can be attributed to dividends and the power of compound interest. That's a strong incentive for sticking with REITs, specifically those sectors that are positioned to do well when rates rise. So let's take a look. Today we're not going to go into too much detail on REITs. We'll take a look at a couple of REITs here. But what I want to focus in on is the relationship between yield rates and REITs. And so that's why I'm going to begin here with the 10-year Treasury yield using MarketWatch, and the symbol is TNX. And the chart we're looking at is the All Data monthly chart. And you've heard me talk about interest rates before, particularly when I was discussing bonds. And in my opinion, and this is not the opinion, the consensus opinion in the market. The consensus opinion in the market is that interest rates are going to continue to rise. I don't believe that is necessarily true. And my opinion is that rates are near their highs now and, in fact, may reverse soon enough. And so if interest rates do reverse, then that would be a good sign for real estate REITs. So taking a look here again, this is the chart on the 10-year Treasury yield. And as you can see in the far right margin here, it looks like the 10-year Treasury is hovering around the 3.0% yield. And if I'm right, again, if it's at the high, and if we turn and head down on the yield, that would be good for REITs. And as we move here into the MAC, as well as the stochastic and the Williams, in my opinion, it looks like we're at highs. See, we're at just a positive point or two measure here on the MAC in the far right, if you can see. And it's only reached that point back here, which was in, say, mid-2006, and then back here, which was in mid-2000. Now, this point here in early 2014 didn't quite reach that level, but it was close enough. But as you can see, in each of these occasions, the interest rates did turn at this level. Looking at the stochastic, it looks like the stochastic is heading down just slightly. And then into the Williams also looks like it is eroding a bit. So this is bolstering my opinion that the yield in the 10-year is peaking at this point. It's not going to necessarily head down immediately, but I think we're peaking at this point. Let me take another look at the 10-year using a slightly different chart. And this chart here is slightly different in that we're looking at the price display on a logarithmic scale. And what I want to focus in on is just here recently, the move from, say, 13, and we'll just round it off. Hey, it was 15, up to about 30. That is a double in the yield over perhaps a near 2-year period. Going back to here, it also went from, say, 15 up to about 30, and that was a double in that yield rate. And back in any of these other periods of history, as you go back, there has never been such a steep increase, a doubling of the interest rate. Now, interest rates did get fairly high up here. However, to me, it's the magnitude of the doubling of the interest rate here in the last, say, 2 years. That has a huge impact given how much debt out there in the private, the corporate, and the governmental sector. These interest rates, the doubling of these interest rates, are going to have a huge impact in all that debt out there. So that's another reason why I think we're probably near the peak and perhaps a turning point. And if I'm right, that's going to be favorable for REITs. So now let's go take a quick look at a couple of REITs. Continuing with the Market Watch charts here, we're looking at PSA, which is a public storage. It's a self-storage facility, a large REIT across the country. And we can see that its current price was $229. So the point I want to make here is that, as you can see, it looks like the stock bottomed here in early 2018, just above, say, 180, and now it's run up to above the 225 at 229. And if you go back down here and take a look at the MAC, as well as the stochastic and the Williams, and you can see that the fast line seems to have bottomed here in early 2018, is heading on up, and in fact the fast line, if you can see, looks like it's moving right through the slow line here. And you go back all the way to 2001, and you can see that the only other time that it was negative was back here in the great financial crisis in early 2009. So the fact that we're all the way down here now is telling me that perhaps these REITs know something that the market doesn't know, which is maybe interest rates are turning. And perhaps that's why some of these REITs are turning. And as you can see here, things have improved, at least by the stochastic, since late 2016. There's been an upward trend and a relatively decent upward trend also in the Williams, with a spike down here into early 2018, and perhaps that coincides with the correction that we had in late January, early February of this year. But again, going back up here to the price chart, in my opinion, I think interest rates are turning. And if you remember the video that I did not too long ago about triangulation, when you're taking a look at stocks such as REITs, you also want to take a look at interest rates. What are interest rates doing? Because that's going to have an impact on your stock or your REIT. You want to have another perspective. You don't want to just look at a one-legged stool. You need to have multiple perspectives, and one of the ways at looking at something like this, or perhaps gold, is to take a look at interest rates. So not only do interest rates look like they're turning to me, so do REITs. Let's go to another REIT. And we're looking at Simon Property Group, which is SPG. And for brevity purposes, I'm not going to go through the whole thing. This, to me, looks very similar to what we just went through with regard to PSA. It looks like the stock or the REIT bottomed here in early mid-2018, and it's heading on up. Now, Simon Property Group, I believe, if it is not the largest REIT in the country, it's one of the largest REITs. So this is a pretty good proxy to take a look at. And again, similar to PSA, you go back here in history, and the only other time that we had a very negative stochastic as well as MAC or Williams was here in, say, early mid-2009 at the bottom of the great financial crisis. But again, all of these oscillators are showing that things are improving since, say, late 2016, and in this case here, the Williams, mid-2017. Things are improving. So back up to the price chart. My conclusion is perhaps rates are done rising, and perhaps REITs are done falling. So think about it. And for today, that's ChewDog Charts. Thank you.